Now friends, let us come to this particular question ID number 5. Let me read the question. X, 28 years, is a resident and ordinarily resident in India. His income is 8,96,000 from business in India and rupees 1,92,000 from a business in the foreign country, with whom India has avoidance of double taxation agreement. According to the ADT agreement, income is taxable in the country in which it is earned and not in the another country. However, in the another country, such income can be included for the computation of tax rate. According to the tax laws of foreign country, business income of 1,92,000 is taxable at the rate of 23%. During the previous year, the X has deposited rupees 42,000 in the public provident fund account, out of which rupees 10,000 is deposited out of the foreign income. He has also received an interest of rupees 32,000 on the government securities. Now, it's a very good question, and this type question, which is also come in the examination condition, many students, friends, have failed to understand the correct application of this particular question and pay maximum attention. That it is very simple after you understand, but this is a very silly point which oftenly students go wrong in the examination condition. Now baby, let me go through this question first of all. See, X is 28 years, resident and ordinarily resident. Okay. His income is 8,96,000 from business in India. So Indian income is 8,96,000 and 1,92,000 is from a business in the foreign country. Okay. So naturally, if you see this, your foreign country, your income is 1,92,000. In India, you are resident. Okay. Now, because you are resident in India, you will be liable for global taxation in India, and naturally, in your computation, this 896 will of course be included, plus this 1,92,000 will also be included in your Indian computation. And this is the stage where the double taxation will emerge and it will come into existence, because same 1,92,000 taxed in that country and it is also taxed in India. Now, in a foreign country with whom India has ADT agreement, that means India has got avoidance of double taxation agreement. So, moment you say that India has a ADT agreement, in that case, section 91 will not apply. I repeat, section 91 will not apply. I repeat that, baby, section 91 will not apply. And this is one of the mistake that majority of the student does. They will just go with Indian rate, foreign rate, whichever is lower, and doubly taxed income, and they'll multiply. Nah, you don't have to do that, baby, because section 91 do not apply. Okay, so see why it do not apply, because India has avoidance of double taxation agreement. Okay, now see this particular small little barrack provision, section 91. I'll again and again repeat this because students will always do a lot of mistake. See, resident, okay, having some foreign incomes where there is no agreement, under section 90. This is one of the precondition of giving a relief or a rebate under section 91 or a deduction under section 91. And that is the reason in the given question, section 91 is not applicable. It is not applicable. Okay. So that was one of the very big silly mistake that oftenly students will do. Okay. And why they will do that? Because, see, to confuse you, that relevant data is also given to you in the question. See, I will tell you. There the students really get confused because data is given. Okay. Now, if you see this, it is given here. According to the tax laws of the foreign country, business income is taxed at the rate of 23% in that country. So you are already given a foreign rate of tax. This is a foreign rate of tax basically. But in the given question, this is not required only. This is to confuse us. Because under section 91, we know that foreign rate, Indian rate, compare it, whichever is lower. That is the remedy of section 91. But in the given question, section 91 does not apply. Okay, because India has already got a avoidance of double. So these data which is given to us, no, in the question, this is really to confuse us. This is really to confuse us and push you to the wall in an examination condition so that you do those mistakes. Yeah, students will do these mistakes. Okay, so one of the main point, otherwise computation wise these questions are not that great, but once you have done this mistake, then you are out, you are clean bowled. Okay, so once India and that country has got the ADT agreement, then what is that we are supposed to do? Then in that case, we have to follow the agreement. So whatever are the provisions of the DTAA agreement between India and that country, we have to follow those provisions. So whatever remedy has been provided by the double taxation treaty, whether they are giving you tax rebate, whether they are giving you exemption, it depends on what the treaty has provided for. So in real life, friends, you have to open that treaty. This will be few pages treaty. Then you have to read that this is the type of income, so what is the treatment which is recommended. And then under section 90, you have to apply the beneficial provision. That means a domestic law, that means a local provision, our normal income tax provisions, or DTAA provision. Basically the DTAA rates of tax. By and large, it is about rates of tax. So whichever are beneficial, that beneficial provision you have to apply. That is section 90. So in the given question, because there is ADT agreement, section 90 will be applicable. Okay, and in that case, you will have to follow whatever the provisions of DTAA are, and you have to apply the DTAA provision as beneficial to the assessee. So first of all, friends, that is something which I want to bring it to your notice, that section 91 don't apply here. So section 90 will apply. But in a typical situation, section 90A will apply. But anyway, 90 and 90A is just the duplicate kind of provisions in a little bit different situation. See, section 90 will come into picture where the government may enter into an agreement with the government of country outside India. That means Indian government and that government has signed up a treaty, which you call as a double taxation avoidance agreement. So these provision will be applicable. Okay. Now, once this particular provision is applicable, this is one of the very, very valuable aspect of section 90 subclause 2. It says that wherever you have entered into an agreement, okay, the provisions of this particular act shall apply to the extent they are more beneficial, as they are more beneficial to the assessee. That means basically now you will have to put yourself in a position, Indian tax law or DTAA, that means a domestic law or the DTAA, whichever is more beneficial, I repeat, whichever is more beneficial is to be applied. Okay. Further. So, and once you have understood this only, then question becomes very simple. Very simple. This is question ID number 5. Okay. Question ID number 5. Okay. Assessee is resident. Okay. And DTAA exists. That means India and that country has got DTAA. And thus the treatment will be given under section 90. And section 91 will not be applicable. I'll just write and cut it for your better understanding that section 91 don't apply in the given circumstances. So don't follow that Indian rate, foreign rate, whichever is less. That system you have not to follow right now. In the given question, you have not to follow. Is that clear, baby? Hakuna Matata means no worries. I guess that this is absolutely clear, darling. Okay, because if this mistake you do, then the whole answer goes wrong. Okay, so now under section 90 you have to follow what the law says, what the DTAA says. Now there the interpretation is required. Okay, so it says that according to the ADT agreement, so this is what you have to follow now, because it is according to the ADT agreement, income is taxable in the country in which it is earned and not in the another country. So income is taxable in the country in which it is earned and not in the another country. So what is the meaning of this sentence? Okay. Okay. Foreign country, India, okay, and there is DTAA. DTAA is already there. Okay. Now in India, assessee is resident. Okay. And in the foreign country, it has got an income of 1,92,000. Okay. Now What is the meaning of that sentence? That is only what you have to understand. Is the heart of this particular question. According to the ADT agreement, income is taxable in the country in which it is earned and not in the another country. Okay. So these 1,92,000 is taxable in the country in which it is earned. This country normally we call it as a source country. This is called as a source country because that is the country in which you have a source of income. And India in the given example, in the given situation, will be a home country. A home country is a country in which you are resident. Okay, this is international words which are oftenly used. Okay, so as per the ADT agreement, 1,92,000 is taxable in the country in which it is earned. That means in the source country it is taxable, and 1,92,000 is not taxable. In the other country. This is what the question has given us the data. Okay, it is taxable in the country in which it is earned and not in the other country. Okay, not in the another country. That's the meaning of this particular sentence. And this meaning, if you are not able to interpret, no, you cannot give the answer. Understand this very carefully. In which it is earned and not in the other country. And not in the other country. Okay, however, in the other country, such income can be included for the computation of the rate. However, in the other country in the given question will be India. In India, income can be included for the computation of the tax rate. So, it is not taxable here, but it can be included in the computation for the rate purposes. Okay, what is the meaning of this? The meaning of this is that you have to include 1,92,000 for increasing the average rate of tax. However, 1,92,000 is not taxable in India. So what you have to do? You have to do one summary computation in which you have to include 1,92,000 and you have to calculate the average rate of tax. That will be your step number 1 in the given question. And whatever is the Indian income, that will only be taxable in India, and that Indian income you have to multiply with the average rate of tax. Absolutely clear, everyone? Okay. So the tax liability computation in the given case. Tax liability of the assessee in the given case logically should be done like this. Listen very carefully. Indian income multiplied by the average rate, Indian average rate if you want to write, because only Indian income is taxable in India as per the double taxation avoidance agreement. Indian income multiplied by average rate Indian is equal to the tax liability. Okay, but in order to calculate this average rate, in order to do the calculation of this particular average rate, you will have to include 1,92,000. So that because of that higher income, you will go in the higher slab, and because of that, the higher average will come. I mean, that's the intention of the law. So this is the interpretation, and this is one of the remedy which is provided by double taxation agreement. Okay. So I once again repeat. Because this is the heart of, otherwise calculation wise, then it's a pure calculator work. That will not be a big problem, baby. See, I will tell you, according to the ADT agreement, income is taxable in the country in which it is earned and not taxable in the other country. That means it is not taxable in India. However, in the other country, that means India, such income can be included for the computation of the tax rate. Okay, so I'll be including it for the tax rate purpose. Now, according to the tax laws of the foreign country, business income is taxable at the rate of 23%. This statement is basically given to us to confuse us. This is the place where students will really cry. Because moment they will see this 23%, no, what they will do, oh, they will get the feeling that, okay, this is a question as per section 91 and Indian rate, foreign rate, whichever is less, this is what they will do. You're not to do that, baby, because section 91 in the given question is not applicable. Okay. Now, during the previous year, X has deposited 42,000 in the PPF. So, all that ATC and all that, out of which 10,000 is deposited out of the foreign income. Okay, fair enough. Here, one small little interpretation confusion is there, but that we will solve it by writing a note. He has also received an interest of 30,000 on the government securities. So, straight away computation is started. 896 is your Indian income. 196 is your foreign income. 32,000 is your interest income. Okay. And he has deposited 42,000 in PPF, out of which 10,000 is deposited from. That 42,000 is your ATC, but that includes your 10,000 which is out of the foreign income. That could create a confusion, but I will address that point also. Okay. Now let's start away with the. So this is your tax liability, actual tax liability calculation. So you will want Indian income multiplied by the Indian average rate is equal to the tax liability. This is your ultimately final answer. Okay. Now your working note. Basically, now you are doing all this working note for getting the Indian average rate. Okay. So let's start with the computation now. Very precisely, computation. And where is a little confusion that I will address it, but no big deal. Okay. Now you have Indian income. 8,96,000. You have Indian income as interest income. 32,000. You have foreign income. Foreign income is how much it is? 1,92,000. On this, the tax, some data is given at the rate of some percentage, but that is not relevant data, but I will just write it so that it is 23%. It is already given to us here. Let me erase this now. Everything is red, 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 baby. Red. Come on, darling. You know, my subject, taxation, is my darling. I call my subject my darling. Okay, 23%. Okay. So you can just make a note here, tax at the rate of 23%. This is not very much relevant, but I'm just making a note there. Okay. So this is what you have got. Total 11,20,000. Then you have ATC 42,000. This 10,78,000. Okay. Now ATC includes 10,000 out of foreign income. Now this could make a difference. I will tell you how it could make a difference. Now see what happens is you want the Indian income. Ultimately the tax is on Indian income. Okay. So see, your Indian income is 8,96,000. This is your Indian income. Okay, 8,96,000. 32,000 is your Indian income. And 42,000 is your ATC deduction. Okay. So confusion will come that these 10,000 which is actually deposited out of the foreign income, will you consider it as a deduction against the Indian income? Okay, so some people will take the view, that you will consider in the given situation, because ultimately you have to break up 10,78,000 rupees into your Indian income and the foreign income. This is something what you will have to do. Okay, so some people will say that my foreign income here will be 1,82,000 rupees, because 10,000 which is out of the foreign income will be adjusted against foreign income. Okay, but that is not required to be done. But that can be the alternative view. Okay, so this answer, we can give the answer considering both the things, that your foreign income is 1,82,000 rupees. That means to that extent your Indian income will be the balance. Okay, or you can say that my foreign income is still 1,92,000 rupees only. In other words, I am claiming 42,000 deduction ATC against the Indian income. Now, law as such is not very much clear on which front or against which category, Indian income, foreign income, are claiming the deduction. But considering the fact here that 10,000 which is clearly printed in the question that it is out of the foreign income, it creates a confusion. Okay, so what you have to say here is that my Indian income is, listen very carefully, this is 8,86,000 rupees. Okay. How did I get this particular 8,86,000 rupees? My Indian income, because this is Indian income multiplied by Indian rate will be my tax liability. So this is 896 plus 32, okay, minus 42. This is my Indian income. Because as per the question, the foreign income is not taxable in India. What is taxable in India is only the Indian income. Okay. Is that absolutely clear? So this is going to be my what should I say, my Indian income. Okay. Alternatively, the view that could be taken was, listen very carefully. Alternatively, the view that could be taken, it is 896 plus 32 minus 32, because 10,000 deposited in the PPF was out of the foreign income. But we are not following this. Okay. So I'll just cut this. Okay. I will just cut this. We are not following this, but this is a note that you have to write in the examination condition. Is that okay? Now, you got this particular 10,78,000. Now it's a straightforward tax liability calculation. Okay. So just give basic exemption. Slab 1, 2, 3. Basic exemption, slab 1, 2, 3. On everything is on merits now. 87A rebate on merit, surcharge on merit, cess on merits. Okay. Now, you will get a tax liability. Then, moment you will get the tax liability, you will get a Indian average rate. You only want this now, because now you don't want to do that section 91 kind of Indian rate, foreign rate, which this is not required to be done. This Indian rate it will be multiplied, because see, this Indian rate, because of this 1,92,000 will be higher. No, logically it will be higher, because higher the income will be the higher average rate, logically. Okay. So because of that 1,92,000 rupees, the logically this Indian rate will be little bit higher, because 1,92,000 is already included in this particular computation, and this Indian rate, okay, will be multiplied with this Indian rate and get the amount of the tax liability. This is how the computation is to be carried out in the given question. Come on, update your answer fully. And this was one of the main point, friends, in this particular question, that your section 91 is not applicable in this particular circumstances. So this is the answer given, that foreign income is not taxable in India. So we are not taxing the foreign income at all. We are taxing only the Indian income, but we are taxing Indian income at the Indian average rate. But for average rate purposes, we have included the foreign income, because double taxation avoidance agreement specifically provided for the same. Okay. So update it fully, baby. Now let me go to the next question. Next question is also on a similar concept, I guess. Okay, come to this particular question, question number 6. Okay, X Limited is an Indian company. For the previous year, the following incomes were noted. Following incomes were noted from the books of accounts of the taxpayer. Income from business in India, income from business in the foreign country, with whom India has avoidance of double taxation agreement. Now, moment there is a double taxation agreement, section 91 provision will not apply. And that is the mistake. Normally students oftenly, they keep on doing it, baby. And I also have to clearly tell them again and again that, baby, you don't do this mistake. Okay. So because there is a ADT agreement, section 91 will not apply. Okay. And in that case, naturally section 90 will apply. Or section 90A will apply, because 90 and section 90A is on the similar lines, on a similar footing. So section 90 will apply. Okay. And Indian company is always resident in India. You should never forget this. Always resident in India. Section 90 will apply. Now, according to the ADT agreement, according to the ADT agreement, because moment the double taxation agreement applies, this kind of a data has to be printed in the question, because I have to follow what the agreement has stated. So question has to tell me that what did the agreement say then, otherwise then I will be hanging in the examination condition that how will I get the answer. So this kind of a clarity question has to print. Okay, so the question is already printing this. According to the ADT agreement, 2,16,000 rupees. Let me check what is 2,16,000. It should be foreign income logically, because ADT will talk about foreign incomes by and large. So this 2,16,000 rupees is a foreign income, correct? According to the ADT agreement, 2,16,000 is taxable in India. It is taxable in India. Now see what the agreement is saying now. This is taxable in India. In the previous question, what was the fact? You see, it was not taxable in India. According to, so this language you have to underline very properly and understand. According to, in the previous question I am telling you, according to the ADT agreement, the income is taxable in the country in which it is earned and not in the another country. But this question, the language is different. And in this question, it is saying that according to ADT agreement, 2,60,000 is taxable in India. It is taxable in India. However, okay, it can also be taxed in the foreign country. Oh, mamma mia! So it is taxable in India and it can also be taxed in the foreign country at the rate of this 17.5%, which can be set off against the Indian tax liability. So this is a mechanism what we call it as a tax credit. This is called as a tax credit, or somebody also called it as a full credit. This is also called as a full credit. So what will happen is, listen very carefully. In this particular question, the model which is accepted by double taxation agreement is, listen very carefully. See, the model which is accepted by the double taxation agreement is, okay, this is foreign country, this is India, and there is a DTAA. So DTAA has to be followed. Now 2,16,000 is taxable in the foreign country. 2,16,000 is also taxable in India. It is taxable in both the countries. So both the country will tax it. Okay. However, and here that percentage is also given. So at the rate of 17.5% in the foreign country. In India, you will get normal Indian rate. No. So for that percentage, no need to print. Okay. However, this credit can be set off against Indian tax liability. So whatever tax that you are going to pay in the foreign country, this will be given to you as a set off from the tax liability. Basically deduction from tax liability. Set off from the tax liability, you will get it in India. So what you have to do, you have to include 2,16,000 in India, calculate the normal tax liability and multiply 2,16,000 into 17.5%, whatever the tax liability which you have paid in the foreign country, give it as a set off, basically a deduction from the Indian tax liability. And this is how the double taxation have got eliminated. Okay, so objective is always not to do double taxation, but in which method it will get eliminated, it has to be provided in the question, because in the given question, there is a double taxation avoidance agreement. And what is provided in the double taxation avoidance agreement has to be mentioned in the question. Is that absolutely clear, baby? So, the method of presenting the answer will be, okay, let's start with the computation and straight away. Okay, so question ID number 6. Question 6, okay. You have Indian income, you have foreign income, you have Indian income, you have foreign income. Indian income is 3,80,000, foreign income is 2,16,000. It is an Indian company, so apply the tax rate of the Indian company is 5,96,000 total. Okay, calculate the tax liability. So here it is an Indian company, so just multiply the tax rate of the Indian company. So no big deal whatsoever. Okay, so tax liability will be 5,96,000 multiplied by, okay, the tax rate, surcharge on merits. cess on merits. Okay, you will get a normal tax liability. Okay, now it's a pure calculator work. Come on, start doing it. And from this, you will get a set off of the tax liability. Set off of the tax liability as per section 90, because India and that country has got a double taxation avoidance agreement, and that is 2,16,000 multiplied by 17.5%. That is basically what the tax paid in that country. So this is your set off of 37,800 rupees. Okay, and difference is your tax liability after set off. Net tax liability after set off. This is how the working is to be carried out. Come on, update your answer fully. Come on, let us start with this particular question. Question ID number 7. Y 24 years and Z 26 years are resident in India. The following points are noted for the previous year from the books of accounts. Y and Z. Income from business in India, income from business in Argentina. India does not have any ADT agreement with Argentina. Income from other sources in India, bank FD interest, PPF contribution, tax levied in Argentina. Okay, that was simple and straightforward question now, so we can do it in a very fastest possible way. However, for Mr. Z, we will have to do a little bit of extra discussion. Now see, this gentleman, Indian, I'm first of all discussing Y. Okay, first I'll finish Y and then I will take up Z. So this Y, Indian income is 80,000. Indian income out of business is 80,000. Income from business in Argentina and India does not have. So this will be a situation of section 91. So this is your foreign income. Income from other sources in India, bank FD interest. So this is also your Indian income. So basically your Indian income is 80,000 plus 60,000. Then PPF contribution means 80C you will get. Okay, and tax levied in Argentina. So whatever is the tax levied in Argentina, that will be required for your average rate of Argentina. So that is something that will be required. If you want, you can just say that, see, 1,80,000 is income from Argentina and 39,000. So these, if you will calculate into percentage, you will get foreign average rate of tax. So that will be very simple. Okay, and in the given case, the doubly taxed income will again be 1,80,000 only, because 1,80,000 is included in Argentina because business is in Argentina, and is included in India because of your residential. So doubly taxed income will be 1,80,000, and this will be the average rate percentage of the foreign country, and Indian average rate you will get as per the Indian tax liability calculation. So no big deal whatsoever. Okay, only one thing here that you have to be careful, that he is resident in India, and you have to give him the rebate of section 87A if at all on merits it is applicable. So be cautious that when you calculate the tax liability, don't forget the rebate element. Okay, that's all for Mr. Y, no big deal. So let me quickly do this particular computation. Question 7, Mr. Y, very simple computation. In fact, Indian income, I'll just take the total only straight away, 1,40,000. Foreign income is 1,80,000. So 3,20,000. ATC 16,000. So this is 3,04,000. You should check the age also. If it is senior citizen, then you have to consider higher basic exemption. Mr. Y, I will just say resident. Okay, and there is no DTAA, and therefore section 91 will apply. Okay, so this small little comment I'm just adding for the students' better understanding. Okay, now straight away go to the tax liability calculation. Basic exemption, you can straight away start doing it on your own now. Need not wait for me. Slab 1, 2, 3. 87A rebate on merits, surcharge on merits, cess on merits. This will straight away give you tax liability. Okay. Indian average rate, you will get it as per the tax liability over total income, no big deal. Foreign rate, whichever is lower, percentage, doubly taxed income, that is 1,80,000. Okay. When you will multiply, you will get a rebate or relief or deduction, whatever you want to say, under section 91, and this will be your net tax liability. This will be your net tax liability. Okay, so this is how your net working will be carried out. If at all you want to write, you can write a note for that foreign average rate, and that was basically 1,80,000 income, foreign income, okay, and foreign tax paid in the foreign country is 39,000, and this will give you the percentage. Okay. So that's all. Come on, update your answer fully. Once we are done with this, we will start with the computation of Mr. Z. Baby, where is that Mr. Z gone? Okay, now Mr. Z, situation is almost the same, but now for Mr. Z, there is one good point in the computation. So mark that particular gentleman as pretty. That way, format wise, it will almost be the same. Okay, now we are doing for Mr. Z now. See, the Indian business is basically a loss. Foreign income is 5,50,000, and you have income from other sources 1,40,000. So what will happen is your computation, your Indian loss will get set off against your other sources income because of this intra-head adjustments. So that will be one extra adjustment. Okay, so your ultimately net business income here after set off and all that, other sources income is going to be 10,000 rupees. Now see very careful. Okay, now PPF contribution you are getting 80C. So 80C you are getting 41,500. So this 41,500, logically friends, you are getting the deduction 80C. Out of this 10,000 also you are getting it, and plus you are getting it something out of this foreign income also. That means 5,50,000, which is your foreign income. From that you are also going to get 80C. So your doubly taxed income, I repeat, your doubly taxed income is not going to be 5,50,000 fully. Alright, it will be 5,50,000. So your doubly taxed income will be 5,50,000 minus whatever 80C that you are getting it against your foreign incomes. And this is going to be one of the main point. Or put it differently. See, your doubly taxed income, put it differently. A doubly taxed income cannot be more than your total income in India, because what income you are taxing in India, I repeat, what income you are taxing in India, okay, that is only taxed in India. So doubly taxed income cannot be more than the amount of the income taxed in India. Very natural thing, but you have to derive that particular conclusion from this particular working. Okay, now there are two ways to look at it. Both the ways I already told you, but I will repeat that also, don't worry. However, taxes paid in Argentina is 15,000 on 5,50,000. So this is going to give you your foreign average rate. Okay, this is going to give your foreign average rate in this particular computation. Okay, so roughly how much it comes, just use your calculator. I think 2.73% I am getting. Okay, just check. Okay, so this is your foreign average rate. Okay, but your doubly taxed income will not be full 5,50,000. It will be 5,50,000 minus your 80C. As simple as that. Okay, so that Mr. Y is pretty good. Mr. Z in the given question, Mr. Z Okay, resident, no DTAA, and thus section 91 will apply. Okay, computation. Okay, Indian income, business loss is minus 1,30,000, IFOS is 1,40,000, so your net income is 10,000, Indian income. Okay, foreign income is 5,50,000. On this, the tax paid is 15,000. Okay, so if you want, you can write average rate here itself. You can just calculate if you want. Average rate 2.73%. Okay, that is a foreign average rate. This is our GTI 5,60,000. ATC is 41,500. This is where the main point is coming. Now, conceptually, if you see, Indian income is only 10,000. Okay, so ATC against Indian income maximum can be only 10,000. So the extra 31,500 is logically going against your foreign income. Okay, so foreign income which is taxed in India after deduction will be a different figure. That will be 5,50,000 minus the ATC deduction. Okay, so that is going to be the difference. So your total income will be 5,18,500. 5,18,500. Okay. Now, friends, one logical statement I am making, but that way law does not say that. It's only a logical statement I am making. Okay. A doubly taxed income cannot be more than the total income. Naturally, no? Naturally, baby. In India, you are taxing only 5,18,500. So in one country, you are taxing only 5,18,500. So a doubly taxed income cannot be more than, I repeat, baby, that it cannot be more than, I repeat, it cannot be more than the total income. Because you are taxing only in India, in the given question, 5,18,500. So the doubly taxed income cannot be more than the total. This is only a logical statement. Okay, so law doesn't say that. Law doesn't say that, but this is a logical statement. Okay, so now we have to go with the tax liability calculation straight away. Come on, tax liability calculation. Okay, basic assumption. Basic assumption, slab 1, 2, 3, 87A rebate on merits, surcharge, cess. Okay, everything is on merits. You will get an Indian average rate. You will get Indian average rate based on this particular working. You will get it in terms of percentage. Foreign average rate, I have already calculated, because if foreign average rate is 5,50,000 and 15,000. The 5,50,000 is income taxed in that country. So that country you are offering income to tax as 5,50,000 and 15,000 taxes you are paying. So that is coming as 2.73%. Okay, and whichever is lower, okay, multiplied by doubly taxed income. Doubly taxed. This is one of the main point, doubly taxed income. Now here the doubly taxed income will be 5,18,500. Because in India you are taxing only 5,18,500. When you will multiply this, you will get a rebate under section 91, and this is your net tax liability. You can say deduction under section 91. Okay, this was one of the main point. Come on, update your answer. And there is another way to look at it is like, you are getting ATC deduction against the foreign income. That is another way to look at it. Whichever way you look at it, ultimately your doubly taxed income cannot be more than the amount taxed in a particular country. Okay, so in our question it is India. So India, I'm taxing only 5,18,500. So my doubly taxed income cannot be more than 5,18,500. As simple as that, baby. All right, come on. So update your answer fully. Now let's go to the next question. Question ID number 8. Now this question ID number 8, I think it is a straightforward question, so we can complete it very quickly. X 61 years, so senior citizen, musician, is deriving some income. Now see this Mr. X, whether is resident, non-resident, that is not printed in the question. So here you have to write clearly a note that X is assumed to be resident in India. Only then you may think about section 91. Okay, so that is a note which is required. X 61 years, is a musician, deriving income from concerts performed outside India. Amount is 7,50,000. Tax of 1,50,000 has been deducted at source in that country. One note always required here. Moment there is a TDS of that country, it is assumed that this TDS is the payment of tax of that country. Put it differently, this TDS is not a refundable amount. Okay, that means this is basically as good as payment of tax of that country. That is a note which is always required. Okay, where the concerts were given, remaining rupees 6 lakhs is remitted to India. So his outside India income in the given situation is 7,50,000. Okay, but from that 1,50,000 was deducted at source and the balance 6 lakhs. So your net income was remitted to India. So brought in that particular money. Good. India does not have any agreement with that country, and because you does not have, you have to think about section 91, and he is resident. That is not clearly printed, so you have to assume that he is, and he should be resident. He should be resident, because for the purpose of section 91 deduction, a residential status is very, very important, baby. Okay, so assuming that Indian income, okay, now Indian income, the data has been given to us. Let me check out that, baby. Come on. Indian income is 4 lakhs. What is the relief due to him under section 91 for that year? So this is already asking you 91. So okay, we will do that. Indian income is 4 lakh. No big deal. Further, assuming that is deposited 22,000 in the PPF, so you have to give section 80C in relation to this particular figure. So our foreign income is 7,50,000. Indian income is 4 lakhs. So you will get foreign average rate as 7,50,000 divided by 1,50,000 divided by 7,50,000. That is, you convert it to percentage, you will get 20%. That will be foreign rate. Okay, and so this question is pretty simple now, so we don't need to spend a lot of time here. Come on, quickly. Question number is 8. Okay, the age, what is the age given here? Let me check. The age is 61 years, senior citizen. Okay, so that basic assumption you have to be careful. Okay, because senior citizen. Okay, Indian income. Question number 8. Indian income is 4 lakhs. Foreign income 7,50,000. On this, the tax is 1,50,000. The average rate, if at all I can develop here, because normally you can write a separate note, but you can write it in line here itself. There is no problem, because there is no other greater adjustments here. So this is your 11,50,000. Okay. ATC is 22,000. And this is 11,28,000 rupees. So this is 11,28,000 rupees. Now straight away do the tax liability calculation. Give the basic exemption. Lab 1, 2, 3. 87A, rebate on merits, surcharge on merits, cess on merits, total tax liability. Okay. Total tax liability, then Indian average rate. Okay. Foreign average rate, 20% we have already calculated. Whichever is lower in terms of percentage. Doubly taxed income. In the given question, doubly taxed income is full amount of 7,50,000 itself. So multiplied with the percentage whichever is lower and get the rebate of section 91 or deduction of section 91. Deduction under section 91 and you will get the net tax liability. Okay, this is going to be your net calculation. Come on, update your answer fully. Come on.